other forms of access, large companies, particularly public companies, have had access to some of the least expensive money in my lifetime. But today, we will see the Special Inspector General's audit reveals the primary reason why the fund exists was to give banks a backdoor exit out of TARP. That bothers me. I wish it wasn't so. I wish it wasn't in the report. But in fact, while banks were helping themselves, small businesses, the engine of our economy, were not getting the assistance they need. $2.7 billion, or more than two-thirds of all SBLF funds, went to banks that were already in TARP. With the Treasury Department's blessing, these banks used 80% of those funds to exit TARP at a lower interest rate rather than lend it out to small businesses. That means millions of taxpayers were taken away from the American people, millions of tax dollars were taken away from the American people and allowed to sit in the accounts of banks that received TARP funds. With the Administration's blessing, and I might note, administration is a very broad word, and during this hearing we will get more refined as to who in the Administration. TARP banks were able to escape restrictions on governance, executive pay, and luxury expenditures. What I can't get past is the fact that former Treasury Secretary Geithner made the absurd prediction that these banks would lend out $10 for every $1 in funding. The audit sadly found that TARP banks lent out only $1.13 for every dollar in SBLF funds. Once again, the American people were told one thing, and in fact, for self-interest of the banks that received this, just the opposite occurred. There are real inconsistencies to what was said and what was done that create real questions of the Treasury Department should have done and how they are going to explain to us their failure. I asked the Treasury Department to appear before today's hearing. They refused, even though the committee offered them that we would make extraordinary exceptions and accommodations for their participation. Let me be clear. Their absence does not absolve them of the responsibility to answer questions to the American people they have a right to know. I will today submit questions to the Treasury Department in the record, and I imagine the gentleman from Maryland, Mr. Cummings, will also have many questions. I insist that we be answered those questions, or we will have another hearing. This committee looks for waste, fraud, and abuse. To put this money into people who didn't need it is not only wasteful of funds, but it ultimately denied the American people that GDP growth they so much wanted and needed. I represent small business, not just in that I have many of them in my district, but I came from a small district. I know that, in fact, capital accumulation for growth is the hardest thing for a small business to do. They lean heavily on their community banks. They lean heavily at times on SBA. There is no basis under which that should have happened. I might note in closing, TARP has been a success when it comes to big banks paying back their loans. They paid them back early. They paid them back with interest. The truth was most of the banks that received TARP money never really needed it except as a confidence statement. That reality says that this was less excusable, much less excusable, because ultimately they were going to pay it back. This simply gave them an ability to do it sooner and for less. With that, I recognize my partner and colleague in this, Mr. Cummings, for his opening statement.
Thank you very much, Mr. Chairman. And thank you, Ms. Romero, for testifying before us today. We appreciate your service, and we thank you and everyone in your office for the work that you do, and it is outstanding work. Small businesses are the lifeblood of our country's economy. When small businesses thrive, America thrives. When small businesses have access to credit, they hire more workers, and they replenish their inventories. This was the rationale behind the passage of the Small Business Jobs Act of 2010. In order to help small banks increase their lending to small businesses, Congress created the Small Business Lending Fund as an investment in America's future. Since the inception of the program in 2011, it has been a marked success. Lending to small businesses has increased by $8.9 billion, which translates to more than 38,000 new loans to small businesses. More than 80% of these loans are for less than $250,000, and they are making a critical difference to a host of very small but very important businesses. My home state of Maryland has benefited greatly from this program. Participating banks have increased their loans to small businesses by more than $280 million. I'm proud to think of the number of family-owned restaurants, florists, and daycare centers that are thriving with these loans. The Chairman's home state of California is also benefiting from this program. California's small community banks participating in the program have increased their lending to small businesses by more than $590 million. The fact is that the entire country is benefiting from this program, particularly in the Southwest, where more than 11,000 small businesses have received loans, and in the Chairman's region in the Southwest, where 9,500 small businesses have received new loans. Today, we hear about a report issued by the Special Inspector General for TARP that is critical of this program because it allows financial institutions to essentially refinance some of their TARP funds with funds from this small business loan program. We have to keep in mind, however, that this is exactly what Congress authorized. We did this in 2010 when we created the program. We wanted to incentivize banks to make loans to small businesses across the country in order to spur growth and help lift our economy out of the recession. And the bottom line is that the program is working. All of the banks are making their interest payments to the Treasury Department, and not one has missed a payment. In fact, Treasury now estimates that these investments will be repaid fully, along with $50 million profit to the American taxpayer. Although I appreciate SIGTARP's work, today's hearing would have been more helpful to the committee members if we could have heard from additional witnesses. And I agree with the Chairman that that is essential. For example, Treasury officials should be here to offer their response, but they were given only 8 days' notice and they could not complete their testimony in a short time frame, and this is according to them. For this reason, Mr. Chairman, I ask that a letter sent on March 28, 2013, from Deputy Assistant Treasury Secretary Don Graves responding to SIGTARP's report be entered into the record.
Without objection, so ordered.
I also think the committee members would have benefited greatly from hearing from the Special Deputy Inspector General at Treasury, who has direct oversight jurisdiction over this program and has issued reports that appear to conflict with some of SIGTARP's findings. My staff contacted the Deputy IG, but she also was unavailable to attend this hearing on such short notice. For this reason, Mr. Chairman, I ask that the IG's report on this program, which was issued in July 2012, also be entered into the record.
Without objection.
I want to make it clear, Mr. Chairman, while we are entering these into the record, I agree with you. We need the testimony, but I want to make sure that they are part of the record. Finally, GAO also has a statutory mandate to review this program and issue reports. And those reports have commended the implementation of this program. Unfortunately, we do not have anyone here from GAO either. I ask unanimous consent that GAO's report on this program, which were issued in 2011 and 2012, also be entered into the record.
Without objection.
So I look forward to the testimony of Ms. Marrero, but what we will hear today is partial and incomplete assessment of what we have to deal with today. And I look forward, Mr. Chairman, to working with you to getting all of the witnesses that we need so that we might thoroughly address this issue. And with that, I yield back.
I thank the gentleman, and we will extend a future invitation. So hopefully those who could not do it in 8 days will be aware that they will be invited in the future. Perhaps they could start working now. I also want to associate myself with your comments. This is a technical hearing. This is one in which no laws were broken, but in fact there was a more effective use of funds, and you talked about that very favorably, as I would agree, and then there was a less effective use of funds, and it's the impact of that I believe the IG will testify to. Members may have 7 days in which to submit opening statements or other extraneous material for the record. I would now like to welcome our witness, the Honorable Christine L. Romero. She is a Special Inspector General for the Troubled Asset Relief Program and a returning guest both in her current position and her previous position. Pursuant to the rules, if you would please rise and raise your right hand to be sworn. Do you solemnly swear or affirm that the testimony you are about to give will be the truth, the whole truth, and nothing but the truth? Please be seated. Let the record indicate the witness answered it in the affirmative. Because this is a sole panel, we won't hit you with the light and say next witness, but I would appreciate it if you'd summarize so we can get to questions. The gentlelady is recognized.
Chairman Issa, Ranking Member Cummings, and members of the committee, it's my honor today to appear and present SIGTARP's report, and I thank the committee for its commitment to oversight and transparency. TARP was intended to increase lending, but that did not happen, and small businesses were left struggling. So Congress viewed SBLF as a fix to TARP because it gave incentives to lend. And Treasury officials said that banks could leverage each SBLF dollar to make loans in many multiples. As much as $8 to $10 in loans could be made for every SBLF dollar. TARP banks were allowed in SBLF, but it was Treasury who had the authority to choose the banks that would be a good fit for SBLF and the amount they would get. Congress had one clear expectation. All banks were expected to increase lending. SIGTARP's audit is not about whether it was appropriate for Congress to allow TARP banks in SBLF. Our report is about whether Treasury chose the right banks, the right TARP banks to exit TARP and go into SBLF. Nearly 60% of TARP small banks applied for SBLF, while only 9% of small banks outside of TARP applied for SBLF. This should have been a warning sign that TARP banks were looking at SBLF as a TARP exit strategy. When Treasury was choosing banks, we recommended that Treasury not count the TARP capital in assessing the health of the bank. What we said was it made little sense to take a bank out of TARP if it did not have the capital to lend. Treasury rejected our recommendation, and they gave 2/3 of the $4 billion in SBLF dollars to TARP banks. 24 TARP banks actually decreased their small business lending while in SBLF. These banks got $500 million in SBLF, but they decreased their small business lending by $741 million. Where did the SBLF money go? It did not go to small businesses. 14 of these banks paid their shareholders dividends. At least 2 gave their CEOs a substantial raise, a raise of at least 40%. These banks got some of the biggest SBLF investments. So these 24 banks that decreased lending actually got some of the biggest dollars from SBLF. 19 got more than $10 million, 10 got over $20 million from SBLF, and 2 got well over $50 million from SBLF. Now, only 12 banks in SBLF got over $50 million. This cannot be acceptable. The number of banks that Treasury should have allowed to actually decrease their small business lending in SBLF should have been 0. TARP banks had much to gain and little to lose from SBLF. There's no penalty for decreasing lending. The banks pay what they would have in TARP. We looked to see if the TARP banks that were chosen by Treasury increased their lending in many multiples of every SBLF dollar, just as Treasury had promised, and we found that was not the case. 42 banks that Treasury gave only enough SBLF dollars to repay TARP increased their lending by only 25 cents for every SBLF dollar. These 42 banks got 1/4 of the money in SBLF. They got $1 billion of the $4 billion in SBLF. TARP banks as a group collectively increased lending by $1.13 for every dollar in SBLF funds. The non-TARP banks that were in SBLF boosted their lending by 3 times that amount. The application process was essentially the same as it was for TARP, left over from TARP, which is how one banking regulator described it to us. It did not make sense to us that repeating the same TARP process would bring a different result. There is supposed to be one key difference in the application process. Congress put in a lending safeguard. The banks had to submit a plan on how they would increase lending to their banking regulator along with their application to SBLF. That lending plan should have separated the wheat from the chaff. It should have shown which banks best fit the program's goals and which would fall short. The first problem, the plans, the template of which was designed by Treasury, were 2 pages long, not a lot of detail. Second problem, Treasury thought the banking regulators were assessing the plan to see if the lending was achievable, and the banking regulators thought the Treasury was doing it. This lack of accountability resulted in no adequate assessment of the lending plans. There was no consistent, meaningful review of the plans. Treasury did no independent analysis to determine if the lending could be achieved. They only did a check-the-box superficial review to see if certain elements were included. This was a lost opportunity to ensure that the right TARP banks that could lend refinanced into SBLF. There was another lost opportunity when for 2 years Treasury did not ask why 24 banks decreased lending. What can be done? Well, we can't get back the lending that didn't happen to small businesses, but we can focus on the lending that can happen going forward with these banks. So we recommended that Treasury help those banks come up with new plans to increase their lending in multiples as was intended, but Treasury rejected that. Unfortunately, it's the small businesses in our communities that have suffered and will continue to suffer unless there's meaningful lending to them. Thank you again for this opportunity. I'm happy to respond to any questions.
Thank you. And I'll recognize myself first. Could you put the form up on the screen, please? That's the form you're talking about.
That's correct.
So it looks like SAT, but with only 2 boxes, not 4 or 5 boxes to check. It's a 0 or 1 relationship. So all somebody had to do is give themselves the appropriate answer, a 0 or 1, and they were done. Is that right?
It was very superficial. Just check the box if the information was there.
That's a $1 million+ decision on a 1 page. I'd like to show the video in context, not to mock or be unfair to the President or the Secretary, but I think it puts in context the promise made versus what was kept. With audio. Stop the clock. Stop the clock.
Plus, through this bill,
this is the problem with doing videos.
Plus, through this bill, we'll take other steps to promote lending, and this includes our new Small Business Lending Fund designed to help Main Street banks lend to Main Street small businesses across this country. And that's why I began fighting for months to pass this jobs bill, the most significant step on behalf of our small businesses in more than a decade. And once I sign it, it's going to speed relief to small businesses across this country right away.
Well, I think it's going to make a meaningful difference for the banks that qualify and are eligible, and it'll make a meaningful difference for their customers. Because again, the central feature of this program is that you get $1 of capital, and that means you have between 8 and 12 additional dollars of lending capacity. If you're short capital.
Now, in fairness, I want to ask this question divided. For the banks that were not coming out of TARP, in which this was net new dollars at about 1% interest rate, very favorable interest rate, were the President's goals and the Secretary's statements confirmed?
Well, I think they're well on their way. I mean, this program takes a little bit of time, and so they're already at $3.45 increased lending for every dollar.
The goal of getting to 8 or 9 is still there, but essentially, though, for every dollar we put in, we got $3 in lending, and we got a net increase. So substantially, it did get out quickly, and it did get out and do good where it went to banks that had net new dollars to lend. Is that right?
That's right.
And in your testimony, isn't the real problem here net new dollars versus taking a 5% interest rate and dropping it to 1% and saving the difference. And that seems to be the difference between whether I take TARP, pay it back, and then take money that costs me less, but have no net new dollars. And that seems to be really what we're talking about here, is the use of funds was TARP and savings rather than any kind of net increase.
That's why we had recommended, when Treasury was choosing the banks, that they not count that TARP capital. They needed the banks to just stand on their own capital, just like every other bank applying would.
So by paying back the TARP capital, they really not only were standing on their TARP capital, but they were replacing it with this money. So these were banks that, because they still had TARP, in a sense, they were underfunded.
Yeah, I mean, either for the banks that decreased lending, either maybe they weren't the right banks to get into the program, or Treasury could have given them a little more money to try to give them additional capital to leverage funding out. It was Treasury who made the decision to choose the banks and how much funding they would get.
Were any of these banks that did not pass the stress test, that essentially were either close to or below the initial mark?
Well, no, because the stress test is for the largest banks, and these are the smaller banks.
So these banks could have been over-leveraged, not over-leveraged. That wasn't part of the test.
No, those were things that should have been looked at.
So we could have had banks that got TARP money, needed TARP money, and were on the edge, and as a result, they just simply needed that essentially leverage improvement, because what they got was they got a lower interest rate, which went right to the bottom line. 4% of $1 million, is $40,000 real benefit. Is that right?
So if they don't increase their lending at all, then they just pay the same as they would in TARP, which is 5%. But in TARP, after 5 years, that jumps to 9. And even if you increase, if you're in SBLF, even if you increase by $1, you're not going to get that 9% jump.
Right, but if you increase by $1.13, essentially 13 cents of increase, you were paying 1% on that money, weren't you?
Yeah, it dropped down for each bank. Each bank's a little bit different, but basically there's these tiered stages, and all you have to do is lend like a minimum of 2.5% increase to get a drop. Now, some of these had very, very low thresholds, so to do increases at 2.5%, 5%, 10%, for some of these that's a low bar. While everything's helpful, not everything is meaningful.
Okay, but if I got several $1 million and I got out of TARP, I got an interest rate drop of some amount, and I got to increase my pay as the CEO of a bank above what would otherwise have been limited by act of Congress.
That's right. You escaped all of TARP's restrictions and luxury expenditures.
I can see why a bank would do that. Let me just ask one last question. This audit question, I want to understand. You had a choice between Treasury doing it, essentially you had two places to audit, and each party thought the other was doing it. So in a sense, there was no audit. Is that correct, that you had one group that should have done it or the other group that should have done it? Each said, I thought the other was doing it. So what we had was a failure to audit that somewhere somebody didn't notice until you brought it up.
Yeah, it was very compelling to hear, as we interviewed each regulator individually, to hear that they thought the others had done it.
Let me just ask a follow-up to that very, very quickly. Bank regulators do not ordinarily do this kind of audit except on the behest of Treasury. So in a sense, wasn't it Treasury's primary responsibility to see that the audit got done or to do it? It was not inherent a bank regulator's audit, but it certainly is something Treasury could have tasked them with or done it themselves.
This is certainly Treasury's program, and they take responsibility. But I do have to lay a little bit of responsibility on the banking regulators, because the lending plans under the statute were actually given to them, submitted to them, and they were probably in the best position. But ultimately, it was Treasury's job and responsibility to make sure that it happened, because they were running the program.
Thank you. Ranking members recognized.
Thank you very much. I want to make sure, first of all, I want to thank you for your report, but I want to make sure that we have, I guess in Steve Harvey's language, the rest of the story. I mean, because there are different ways to look at the same information. But I want to go back for a moment. How many banks are we talking about, and how many decreased their lending?
So there were 137 TARP banks that were in SBLF. 24 decreased the lending. Now, 24 may sound small, but when you look at the dollar amount, it's a large amount. These were some of the largest. You had a couple banks, 2 banks in that group, for example, that got more than $50 million, and only 12 banks in SBLF got more than $50 million. So you've got 10 that got over $20 million, you got 19 that got over $10 million. So while 24 may look like a small number, the significance is how many that they got $500 million from the program.
I believe very strongly in the 2 words that I use in my office most often is effectiveness and efficiency. And it sounds like that's what we're going to. But, around here we have a tendency, Mr. Romero, sometimes to we get reports or whatever, and then certain things are pulled out and they become the headlines. And a lot of times we have what I call collateral damage of people who did not do anything wrong. As a matter of fact, did everything right and don't always get the credit. And usually, if there is any kind of correction, it's on page 33 at the bottom paragraph. And so I try to make sure that we have the entire story here.
Sure.
Now, the title of today's hearing is Backdoor Bailout. And the implication is that there is something wrong with small community financial institutions obtaining funds under this program and then refinancing some of their top obligations. Backdoor Bailout. That's the title of the hearing. See, you got to understand the climate that we're operating here. It's a little different than your office. So let's set the record straight. When Congress passed the Small Business Jobs Act of 2010, we explicitly authorized this. Let me read exactly what the law says. We did this. The Congress did this. It says, the law says, the Secretary shall issue regulations and other guidance to permit eligible institutions to refinance securities issued to Treasury under the CDCI and the CPP for securities to be issued under the program. Now, Mr. Romero, the CDCI and the CPP are programs under TARP, is that right?
That's correct.
All right. So Congress especially authorized these small community banks to refinance their TARP funds. Is that right?
That's correct. That's not what our report is about.
No. Well, I'm asking the questions, all right? And so far, these banks have been doing a terrific job in paying back these funds. As I understand it, all of the banks that receive funds under this program are repaying them appropriately, and not one of them has missed a quarterly dividend payment. And according to Treasury's most recent estimate, the American taxpayers are set to make a profit of $50 million on this program. Now, I would imagine, you would say that we could have done even better. Is that right?
No, I don't think that's the point.
Okay.
The point is.
But do you agree with what I've said so far?
I have not looked over the whole program.
You haven't looked at how much money we're making, the profit?
No. What I looked at is, just like I looked for the largest banks, how TARP banks exited TARP, I looked to see how TARP banks exited TARP through this program. So that's what I was looking at. That's what we were focused on.
I got you. So let me ask you about a report the GAO issued after evaluating this program. GAO's report said this, and I quote, it says, Treasury's process for evaluating CBLF applicants included several levels of review and input from multiple sources to help ensure that applicants were treated consistently and that banks approved for funding were financially viable and could repay the investments. Do you disagree with GAO's report? That finding?
Well, I do not know if GAO looked at the analysis and if there was any independent analysis on the lending plans, but I can tell you that what we found is in the application process, there was no independent analysis of the lending plans by Treasury to see if the lending was achievable, and that would have applied for all banks. I also don't know I don't believe GAO looked at the difference between lending at TARP banks and lending at non-TARP banks.
Mr. Chairman, before you do that, please, unanimous consent to have the same amount of time that the Chairman had, which was about an extra 1 1.5, 115, okay?
Pardon?
I saw your light on. Is that, I want to proceed.
Oh, I just saw the time, but sure, I ask unanimous consent, the gentleman has an additional minute and 15 seconds.
Thank you
Without objection, so ordered.
very much. Thank you very much. Mr. Romero has, the program also has been audited by the Special Deputy Inspector General within the Treasury Inspector General's office. And all of these offices are very reputable offices. And the Deputy IG issued a report finding that the Department, and I quote, consistently approved institutions that would likely meet their financial obligations to the SBLF program. And do you agree with the Deputy IG?
So again, we were able to do something that maybe some others. If you just look at Treasury and their application process, you might get one view of it. It was when we looked at Treasury and every single one of the banking regulators together, because they were all part of the process, that we saw where each thought the other had responsibility for analysis of the lending plans. So I'm not exactly sure that the Treasury IG could see that, and that's why it was so important as we were looking at how TARP banks exited, that we were able to go in and interview those people, look at their documents in terms of the regulators, because that's where things fell through the cracks, is in the lending plan.
Thank you very much, Mr. Chairman. That's why it's so important that we get the Treasury folk in here, because you get one piece, but you got to have the whole picture.
Yes.
It's like trying a case with just one side.
Sure. Gentleman's time's expired. Chair's been generous with him. And just to note for the record again, that Treasury was invited and given ample opportunity to participate. They refused, even to the point where their existing report would be allowed to be a testimony in response to Ms. Romero's report and the SIGTARP's report. So with that, I'll now recognize myself for 5 minutes. Ms. Romero, so under the scenario that the ranking member painted, would these banks have paid more back under TARP than under the SBLF back to the Treasury?
Yes.
Back to the taxpayer?
Yes, for the banks who did not, who decreased their lending and did not significantly increase their lending, yes.
So therefore, this profit would have been a greater profit had they not been moved into the SBLF?
They would have paid more in dividends.
Thank you. And so with this line of questioning and this question here, the pledge was that these SBLF banks would lend more to small businesses than TARP banks. Did that prove true?
I'm sorry. So the banks would increase their lending to small businesses.
Right.
Are you asking if they would have increased their lending to small businesses in TARP?
Well, no. You compare
no.
a TARP bank to a small business lending fund bank.
I got it. So I apologize. Yes, in the small business lending fund, there was no question you were supposed to increase your lending. You certainly weren't supposed to take the money and decrease your lending.
Okay. So then the question is, the performance of these SBLF banks, these small business lending fund banks.
Right.
Right? The statute requires the banks submit a small business lending plan,
yes.
Correct?
Yes.
Okay. So there was a requirement in statute that the Treasury demand this plan. Did Treasury deny a single bank or any bank, or what is the number of banks the Treasury denied for not having an adequate small business lending plan?
None. There were some who did not include information, so didn't pass the box. They would then resubmit that information. So no bank was denied funding based on their lending plan.
Based on an insufficient or inadequate small business lending plan.
I'll say it this way: based on a lending plan where the bank could not achieve the lending increases that they proposed.
So what was the level of scrutiny by Treasury of having a small business lending plan in order to be in the small business lending fund?
It was not adequate at all. They did no independent analysis to see if the lending was achievable.
So you're saying that the performance did not meet the statute required by Congress and signed by the President?
Yes. I mean, you can't have banks in the program who decrease their lending.
Okay. Interesting. So the idea that we could actually take banks out of TARP and TARP oversight with a greater return to the Treasury and, by the way, the taxpayer,
Yes.
to take them into a different plan that has the very politically popular term small business lending, right, included in it. That's interesting. So if you think about the returns based on this, TARP banks lend out how much per dollar in the Small Business Lending Fund?
Total TARP banks increased their lending by $1.13 for every SBLF dollar.
Okay, so what's the comparison here? How can I compare it? Is that good?
So non-TARP banks increased their lending by $3.45 for every SBLF dollar. So it's 3 times the amount.
So, no, okay. Because clearly, Congress put this in statute. The President touted it. The Chairman Issa showed this video. Clearly, this can't be the case.
This is absolutely the case. It's
so
not
you're telling me a non-participating bank actually increased their small business lending more than a participating bank in the Small Business Lending Fund?
Yes, and not only should it have been obvious that the money would be used to repay TARP, we warned Treasury that this would happen, that this could happen, and we made a recommendation in September 2010 that said when you choose the banks, don't count the government capital in determining the health of that bank, because they've got to have capital that they can leverage into loans.
Certainly. So can the Treasury require underperforming banks to actually develop plans?
Absolutely.
Have they?
No. We made the recommendation in the audit, and they rejected it.
And in your response to your audit, did they say they were, hey, thanks so much, thanks for letting us know, we're going to shape up, we're going to do this?
No. Unfortunately, they took a very defensive posture. They focused on the lending that has happened in the program when, that's sort of like in HAMP, focusing on the homeowners who have gotten help, but not focusing on the homeowners that should have gotten help, that were intended to get help. And that's what we're trying to do. We're trying to say, don't give up on these banks now. Like, there is still an opportunity to help small businesses with these non-TARP banks, and so work with them to do that, but that was rejected.
Well, my time has expired, but you said the word HAMP, and so that, of course, raises my ire based on that poor performance and what it's done to folks it's intended to help. And now we'll recognize Mr. Clay of Missouri or Missouri, depending on where you are.
Thank you, Mr. Chairman, and the correct pronunciation is Missouri, like it's spelled with an I. Anyway, let me thank the witness for being here today. When Congress authorized $30 billion to establish the Small Business Lending Fund, we intended to provide an incentive to community banks nationwide to increase their small business lending. Banks were eligible to apply for SBLF as long as they met the legal requirements. Banks that were not paying their TARP dividends were not eligible to apply. Ms. Romero, your report raises a concern about the fact that only 935 community banks applied to SBLF when there are approximately 7,000 community banks that could have been potential applicants. Can you please elaborate on that number and why there were so few?
Sure. The number is about 9% of community banks that were not in TARP applied, while about 60% of community banks in TARP applied. Why that's the case, I can't elaborate on, sir. I wish I could, but all I've looked at in this program is how TARP banks exited TARP. So I haven't looked at, I don't have jurisdiction over the whole program to say how was it marketed in the beginning or what was set up in the beginning. I'm only looking at the decisions that were made to take banks out of TARP because I'm the Special Inspector General over TARP.
Now, I heard you mention that some of these banks repaid TARP with SBLF funds.
Yes.
And how did that? And I mean, look, they got TARP money, then they took SIG-TARP, and I mean, SBLF, and decided that they were going to repay the money they owed taxpayers, basically, with this money. Isn't that a shell game?
No, that was okay. Congress allowed that, and we're not taking issue with that TARP banks could use the SBLF money to pay off TARP. That's Congress's call. What we're saying is it was Treasury's call as to choose the right TARP banks to do that, and to also determine how much money they would give them. So, for example, they could choose the banks that would best lend, and they could. It would have been obvious to them that if the bank did not have any additional capital to lend, that just giving them enough to pay TARP would not leverage into the multiples of loans, which is a basic premise.
Well, your report says SIGTARP found that 42 TARP banks that received only enough SBLF funds to pay off TARP have lent out significantly less than they received in SBLF funds, increasing lending only by 25 cents for each dollar of these funds. Speaking of Missouri, give me some examples of banks. Can you name any Missouri banks
Yes.
that you, yeah.
In the 24 who decreased lending,
Yeah.
there are 2 Missouri banks who decreased lending while in SBLF. Do you want me to name them?
Yes, please.
Liberty Bank Shares decreased lending by 20%. This is small business lending. Fortune Financial Corporation, which decreased lending to small businesses by 13% while in SBLF.
Wow. Okay. Do you GAO surveyed banking institutions to learn why they had not applied for SBLF funding and reported that the primary reason was a lack of interest in the program. Respondents' most common reason for not applying to the program was a lack of demand for small business loans. Do you disagree with GAO's findings?
Well, I very much respect GAO and the other IGs. I don't disagree with the findings, but I think it's interesting because there should not have been any difference in loan demand based on whether you were a TARP bank or not. So to see 60% of TARP banks apply to SBLF and only 9% of the non-TARP banks, if there's not enough loan demand, then there's not enough likely loan demand in the TARP banks too, and that sort of sends up a warning flag to me that some banks may have been looking at it as a TARP exit strategy.
Thank you so much.
Thank you.
I thank my colleague, and I recognize my colleague and neighbor from North Carolina, Mr. Meadows.
Thank you, Mr. Chairman, and Ms. Romero. Thank you so much for your illuminating and very detailed report. Obviously, thank you to your staff as well for being so well prepared. As we start to see some of this come out, I appreciate your willingness and your thoroughness in trying to get the full picture. So many times what we do is we look at one segment of government and we say, okay, well, they're performing up to their standards. We look at another, they're performing up to their standards. But when we put them together, we find that the result, as in this case, is not something that helps small businesses at all. And I can tell you that my colleague opposite, talking about the GAO standards, saying there was not a demand for small business loans. As a small business owner for over 28 years, I can tell you there was never, ever more of a demand or a need for that within the community banking system as was evident in this particular time. So I would certainly disagree with their assessment of this particular time. You mentioned that roughly only 9%, I think, of community banks not in TARP applied for the SBLF funds. Isn't this in itself evidence that this was not an effective way to stimulate lending? When we see it, it becomes more of a backdoor for TARP than it is for lending to small businesses.
Well, certainly for several TARP banks, it was a way to get out of TARP. Absolutely. Whether it's indicative of how they marketed the program, I don't really know how they marketed the program. This isn't something we looked into because we were looking at the TARP banks. But it does raise a flag as to whether there was the right reach out to get the right banks in the program.
And I think in your testimony you talk about the fact that you did exhaustive research, I believe, on 32 applications, SBLF applications. And from that for almost all of them, I think 29 out of 32 applications, there was no evidence of any oversight or investigative nature on the part of Treasury to look at a detailed plan on how it would increase lending. Is that correct?
That's correct, and it actually goes broader than that. When we asked the questions and did interviews and we looked at all the documents, we were told by the program director for SBLF that Treasury did no independent analysis to determine whether the lending in the lending plans was achievable, because they thought that was the bank regulators' jobs. We found no independent analysis. So his statement was borne out by the documents. And then on top of that, we looked in detail at 32 and found that there was almost zero mention of the lending plans.
Okay. So from a legislative standpoint, they were required to come up with a lending plan, but yet they didn't do it, and we still gave them the money.
That's correct.
In the private sector, would we call that fraud?
I don't know whether it's fraud here. I'm also in charge of a criminal law enforcement agency, so that's not something we've looked at. But I would say it was very disturbing that there was this massive lost opportunity in determining which banks were the right banks to exit TARP and go into SBLF.
So at best case scenario, it was a gross mismanagement of oversight in terms of the implementation of this process.
It absolutely should have happened. There could have been 3 levels of review to make sure that these banks could have achieved the lending plan. Could have been at the subsidiary bank regulator, could have been at the bank holding company regulator, which is the Federal Reserve, which actually got the bank holding company got the money, and it should have been at Treasury.
All right. I've got just a little bit of time remaining. So you talk about 24 institutions that actually decreased lending.
That's correct.
But at the same time, some of those institutions were paying better or higher bonuses and salaries and payouts to executives. Would you say that was systemic throughout or just isolated?
So 14 paid dividends to their shareholders, and we found that's a problem. And that
so instead of making loans
happened
to small businesses, they paid dividends to shareholders instead of the money that they borrowed for that particular cost.
Absolutely, and not all of those banks are public, but we looked and we saw at least 2 instances where they gave their CEO a raise.
Okay, and lastly, is there any way that we can say where we are today, Treasury, you can fix it? Do you see a willingness on their part to fix it going forward?
Look, I am a glass half full kind of gal. I would like to see small businesses get the benefit. If we're going to have the trade-off of getting these banks out of TARP, I'd like to see small business increase. So we put our heads together to try to figure out how to do that and said, why don't you work with the banks? It's not too late to try to get new small business lending in the future. We did not think that's the prudent thing to do. It's not difficult to do, but Treasury rejected that.
I thank the Chairman for his patience, and I yield back.
Ms. Duckworth of Illinois.
Thank you, Mr. Chairman. Ms. Romero, what I see here for me is a basic missed opportunity to get lending out to small businesses. Time and again, my small business owners in my district have said that lack of access to capital is one of the greatest challenges they face. And here we have a program that could get out as much as $30 billion, and we only use $4 billion of it. And this, at the most fundamental point for me, is a real lack of opportunity. It's opportunity wasted. And I'm really disappointed that Treasury did not accept the invitation to be here, and they could not be here today, because I would like to have heard both sides of the story. From their letter to you, from I think Das Graves, his response to some of your criticism was that the former TARP banks did report a medium small business lending increase of 18.4%, and that 84% of those banks that participated, former TARP banks that participated, actually increased their small business lending, and 73% of those increased their small business lending by 10% or more. You had said that one of the problems with this program is how Treasury chose how much money they would give banks, and that if they only gave banks just enough to cover their TARP repayment, that's what they went with. Do you think that perhaps part of the issue here is that the lending criteria was simply too rigorous, other than the other way around, which is what you suggest?
You know, it's a really good question. It could go either way. If the banks really had no intention to lend and really had no additional source of capital to lend, then they shouldn't have been in the program at all. But for the ones who submitted the lending plan, there should have been more rigorous criteria, which is to really look at that. And I appreciate the increases in lending that happen, because any increase in small business lending is helpful. But not all increases in small business lending have a meaningful impact. So remember, we're talking about banks that had very, very low lending levels. So even increasing it 10%, while it's helpful, it's not really a high bar. And that's why the goal of SBLF was not a 10% increase. The goal of SBLF, that's just how you determine your cost of capital. The goal is really, it's very basic principle of lending, that you take that money as capital and then you leverage off that and loan in multiples. And that's what we were looking for, and that's what we haven't seen happen.
Thank you. I'd like to yield the remainder of my time to the ranking member.
Thank you very much. I just want to thank you very much, the gentlelady for Leone. I agree with Ms. Duckworth. I want to see every single small business get the money that they need, and there's a tremendous demand in my district. And we are handicapped in this hearing because we've got reputable people who seem to disagree with you. And I wish we had them here. I really do, because some of the accusations are quite strong. And everybody on both sides of the aisle knows that I'm a great defender of people's reputations. And did you ever have a chance to talk to Don Graves? Did you talk to him? He's in charge of the program.
Yes.
You did talk to him?
We coordinate with him, his office. We also coordinate with GAO and the Treasury Inspector General. And I don't think anyone is in disagreement with what we're saying.
Well, let me just tell you, I'm just looking at a letter, and this is why I'm going to be pushing hard to get Treasury in here, because, again, we want to make sure our constituents benefit. And when we've got, well, let me read this. Mr. Graves said in his letter of March 28th, he says here, the report ignores, talking about your report, ample evidence that Treasury conducted a serious review of applicants' lending plans. For example, of the banks in SIGTARP sample that received SBLF funding, Treasury rejected as inadequate over 30% of the initial plans submitted by these institutions. Now, as I sit here and I'm listening, I didn't hear anything about that. Is that, I mean, what's going on there?
Sure, yeah. I'm actually really glad you gave me an opportunity to talk about that. The serious review they did was to take the form that I included in my testimony and determine whether 12 elements were included in the plan. If something was missing, or if there was something that was deficient on their face, like they had to at least say they were going to lend out in the same amount of money they got in SBLF. If the amount was too low, Treasury would send it back. That was their review. The banks would then just resubmit it with the information or change the number without any justification. So there was a review, and I'm not saying there wasn't a review, but what we're saying is it was superficial. What we were looking to see is, did you do an analysis or anything to determine whether the lending increases that they proposed in the plan was achievable? And we were told no by Treasury. We did not do any independent analysis because that was the regulator's job. And we were told by the regulators, no, we did not consistently do an analysis because that was Treasury's job. Our job was to look at safety and soundness. There were a few instances where some of the bank regulators, particularly OCC, actually took a look at that, but like the FDIC, who regulated 69% of the TARP banks who applied, that wasn't their protocol. It wasn't their process, and they said Treasury knew we should be doing that. So while the Treasury did a review and rejected some things on a check-the-box basis because the box wasn't checked, they never did an independent analysis to determine whether the lending increases could actually be achieved, and that's what these lending plans were for. I mean, when Congress put this safeguard in, we said they wanted to make sure that we wouldn't have a repeat of TARP, that the banks would actually lend the money out. So Treasury's SBLF program director told us twice, we did no independent analysis. That was the regulator's job because the statute required the lending plan to go to the regulator. That was borne out by the documents. That was borne out by everything we saw. And then when we went and talked to the regulators and the regulators said that was Treasury's responsibility, that was borne out by the documents that the regulators gave us. And so what we're saying is the review, we're not saying there was no review. We're saying the review that happened wasn't a sufficient, adequate assessment to determine whether the banks had the wherewithal or could actually achieve the lending increases that they had proposed.
Thank you very much.
Thank you. I'm going to recognize myself for 5 minutes. Ms. Romero, would this checklist for the banks be similar to what scrutiny businesses would go through for a lending program?
No, and it shouldn't
Not even close, is it?
It shouldn't be how the government makes their investments.
Wow. Would you consider $1.13 return versus $1 investment a good portfolio?
No, and I wouldn't consider taking $500 million and then not lending off of it a good portfolio either.
It's pathetic. I'm a businessman. I happen to be a dentist for 25 years, so the return on investment was pathetic. Mr. Geithner, when the Secretary talked to Congress in regards to this program, did he misrepresent this program to Congress?
Well, I mean,
specifically in that clip, he talks about a return on investment, of lending of $8 to $10 for every dollar invested. That's clearly not what transpired here.
I think the intention was there. I think the problem was in the execution.
So let me get this straight. Wow, thank you. So execution really poor again. It seems we have a recurrent theme here with the Secretary of Treasury that we have very poor oversight. Maybe we mean well, but we have very poor exercise of the facts. And is it not financial aspects are about facts and about details, is it not, Ms. Romero?
The facts and the details are incredibly important here.
Wow. Secretary of Treasury, we can't get those right. Let me ask you what's fair. If a bank made a dividend purchase, do you think it's fair that the taxpayer should get it back? And how about the CEOs getting those pay? Shouldn't we get that back? That should be fair, right?
I absolutely agree with that. That never should have been allowed, and it should not be allowed in the future. And we've made a recommendation to banking regulators to never allow it again, and they've rejected that recommendation.
Wow. So the ranking member just talked to you about a letter from Mr. Graves about a rigorous, serious review of these protocols. That checklist, to me, is hardly a serious review. And it seems like we go over and over again pointing the finger, the blame game, so that we don't know who is responsible for this. But it really lies with Treasury, does it not?
It's their program.
Would you kind of, I know you went in depth a little bit with Mr. Graves' letter in regards to the ranking member, but for mom and pops out there, that's really ill-intentioned, right?
Treasury is absolutely responsible in picking the right banks to go in. And when Congress says, well, we don't want a repeat of what happened with TARP, we're lending an increase, so we're going to fix it. And our safeguard to make sure that they lend is to require a lending plan. When there's no meaningful, consistent review of that lending plan by the government, then the intent of Congress is thwarted in putting that safeguard in.
I'm glad you brought up the intent of Congress. Do you believe that this bill was well vetted?
You know, I don't have any idea on whether how Congress vetted it.
It seems to me that this was very ill vetted because it's the application. You always look at outcomes. What was the intended course and the outcomes? And this is a failure by any stamp of the imagination. And we didn't vet this bill very appropriately. This was rushed through in Congress. We actually had a Secretary of Treasury misrepresenting the plan, at least giving it expectations that there was no intentions of follow through. Because what I see the Secretary of Treasury doing is explaining one thing to Congress and then following through with nothing, absolutely nothing. And wait a minute. You made a comment that said that the numbers matched the TARP numbers. Did you not? So there must have been very interesting dialogue behind the scenes, right?
The 42 banks only got enough SBLF dollars to pay off TARP. It should have been obvious that the banks then did not have capital to lend off of. And beyond being obvious, we sent a letter to Secretary Geithner September 2010 when they were picking the banks, warning of this and saying you can't switch a bank out of TARP into SBLF. It doesn't make sense if they don't have the capital to lend but for the TARP capital. And that was rejected.
The fox in the hen house. Boy, just really interesting. Just one last question. I know I'm running out of time, but do you feel there's adequate capital for small business out in America right now?
No.
What's our #1 biggest area of growth? Is it large business or small business?
No, certainly I agree with Congressman Duckworth. Small businesses really need help here, and that's why we made the recommendation to try to help. That Treasury should even now try to help these banks come up with a new plan to increase lending to small businesses, because that's that's what we're looking at. We're looking at from the small business perspective.
Thank you very much, Mr. Romero. I'd like to acknowledge the gentleman from Nevada, Mr. Horsford, for 5 minutes.
Thank you very much, Mr. Chairman, and thank you, Ms. Romero, for being here today. You know, I've said before that I am not a defender of every Federal program. I'm a defender of my constituents who rely on Federal programs to meet the needs in our respective communities. And when I talk to my small businesses, their #1 issue is access to capital. And so it's incredibly frustrating when, you know, we hear about these programs and the very entities that are responsible for them aren't present to talk about them. And I want to say, for the record, I find that inappropriate. I also feel that we need more input from the very people that these programs are supposed to benefit. I would love to hear from small businesses who both got loans or didn't get loans. I'd love to hear from some of the community banks. Many in my district, it was the community banks that were trying and are trying to work with small businesses in my area more so than some of the larger banks that don't even return people's calls. So, Ms. Romero, my question is, you know, the fact that the Small Business Lending Fund program is different than TARP, that it's an incentive-based investment program, correct?
Yes.
So under statute, Congress directed that funds be made available to community banks and other small financial institutions, including former TARP recipients, with an incentive for participants to increase small business lending, right?
Yes.
So the bottom line is that more banks, the more banks increase their loans to small businesses, the less they pay in dividends. And if recipients fail to increase their small business lending over time, that the price of those dividends goes up as well?
So the best way to do it is for the TARP banks is to do a comparison to what they would pay in TARP to what they pay in SBLF. So if they don't increase at all, there's no penalty to the SBLF banks. They pay the exact same that they would in TARP. So they get to escape all of the TARP restrictions on executive compensation, luxury expenditures, that sort of thing, and they just pay the same amount. If they even increase their lending by $1, they're going to pay less in a dividend than they would in TARP.
And so that's the basic way in which the program is structured?
Yes.
So there's an indication, though, in your report on April 9th that you raised a concern about this process, stating, and I'll quote, "If the former TARP banks fail to increase lending, there is no meaningful penalty." Was that your statement?
Absolutely, and that's what I just explained, because they get all the benefits of leaving TARP, but they pay there's no penalty on them. So for the 24 banks that decrease their lending, nothing is happening with them. No one's standing up other than SIGTARP and saying this should not be allowed in the program, and they're paying the same amount that they would under TARP. So there's no penalty for them to decrease their lending.
And if banks don't pay back the taxpayer in a timely manner, the taxpayer return could be even more substantial. Is that correct?
Yes, and if you have to look at if those banks had stayed in TARP, then if some of these banks, not just the 24, but if we look at some of them that only lent an incremental amount and got a dividend break, if they had stayed in TARP, they would have paid more to taxpayers in their dividends. So what we're saying is while we'll take any increase in lending to small businesses, not every increase has a really meaningful impact on the small businesses that you talked about.
No, and I agree, and I think that ultimately that's what I want to get to. You know, when I look at this chart that was provided to us, the West, the state that I represent, Nevada, was the second to last in small business lending in the region of the country. So I want to know why businesses in my area didn't get the same opportunities to loans, and if that was due to failure on the part of Treasury on the implementation of this program. I expect them to be able to answer my questions as a member of Congress so that I can go back and tell my businesses, this is how this program works, and if you qualify, you know, pursue it, because people need what they're offering, which is access to capital.
I agree.
Thank you very much, Mr. Chairman.
Thank you, and thank you for your insightful questions. Very briefly, I want to make the record straight from a standpoint of a couple of things. First of all, this program is now ended. So we're in the payback phase. There's no net new money. So if I understand from a corrective action, we really can't pull back the money and redistribute it at this point or force higher lending. Is that correct?
Well, that's correct, but I think Treasury should still try to work as hard as they can to try to increase lending. Not through money.
No, and I appreciate that. You know, one of the impressions I got through this hearing was that the President was not well served in the implementation. I think on both sides of the dais you saw that. Certainly 42 banks simply rotated from being covered under stringent rules, bipartisan rules, of accountability and pay and luxury benefits, and they got out of it. They borrowed enough to pay off their loan, so they didn't care. They just wanted one source of money replacing another, and it was pretty transparent when you borrow exactly what you need to get out of TARP, right?
Right, and some of them pay less of a dividend than they would in TARP.
So we lost money through this maneuver.
On those banks, yes.
Now, if I have my figures correct, this program was a $30 billion program, a sizable program.
Yes.
$4 billion actually went out, is that correct?
Yes.
And $2.1 billion went to these basically TARP banks that had little or no return.
2.1 went to pay off TARP.
Went to pay off TARP. So the real tragedy here is, one, the money wasn't used nearly to the level authorized. Two, it went roughly half to paying off TARP. And I might remind all of us that $2.1 billion is not a lot of money into TARP, so it's a relatively small group of banks that got the benefit compared to the total dollars of TARP. The lesson learned that I want to ask, and I'll send this over to Financial Services, hopefully in a joint report, is, if I hear you correctly from your report, one, we need to insist that the term plan be more than a one-page check off the box. We need to find a way to do that in the legislative language and guidance. Two, when we authorize $30 billion, there has to be some expectations of reasonable goals, achievement of, because it's $30 billion, and the gentleman from Nevada made it pretty clear, that $30 billion, if another 26 of it had gotten out there, it would have made a huge difference at even a 3 times multiple as to the availability of funds to small businesses. And lastly, as far as I can tell, we should have had strings on TARP banks. Now, that may never happen again, but we could say any bank which had an alternate government loan from simply paying off one loan with another loan, that should have been explicitly net new capital. Otherwise, there could be no expectation that actual net loans would change.
Absolutely. I would agree with all of those.
And I guess the one more that I got out of the hearing today is defined point of accountability. The language of the legislation was pretty clear, but it was certainly possible for Treasury to say, as they said to you, we thought the regulators would do it, while regulators said we had no specific guidance, and they shirked, if you will, proactive responsibility. Did I cover the points here today?
Absolutely.
Okay, well, I'm going to yield to the ranking member for his closing, but I think what you've been helpful for here, which is unusual, is this is not a big scandal. There is no criminal activity, but there's a series of lessons learned for legislative language that you cannot oversight and you cannot delegate and hope for the best, the areas I just outlined. Would that pretty much summarize what you'd like us to take away from today's hearing?
Absolutely, although I also think that the fault doesn't all lie with the language in the statute. I think when there's an intention in the statute and when there's statements being made to Congress about the intent, that needs to be followed through, and the agencies who are responsible need to take responsibility for that, and there needs to be accountability. And what we said is there needs to be better coordination and communication. We have with TARP, we have with SBLF, and we have with a number of things going forward after the crisis. A government that doesn't want to be stovepiped or siloed. They want to work together. And what we're saying is when you work together, improve your coordination and your accountability and improve your communication. And that recommendation was denied. And we don't see how that can be denied, and it shouldn't be denied.
Well, then I guess I'll put in a small pitch in closing for the DATA Act, something that's been passed out of this committee previously, and something that would provide real-time transparency to oversight both in the administration and obviously would have allowed Congress to be aware of these figures sooner, and the Inspector General's office, I might add. So that will all end up in our report. And Mr. Cummings, do you have a closing statement? The gentleman's recognized.
Thank you very much. First of all, Mr. Chairman, I want to associate myself with what you just said. I think we, it's very frustrating for my constituents. About a year or so ago, we had a forum in my district with the Federal Reserve for small business people, probably about a year and a half ago. And all these small businesses came out, and their number one concern was access to capital. And they had been doing well. And the interesting thing is that a number of them said, look, we've got opportunities, but we can't get the funds to do the job. We can't even get line of credit. And then to hear a program that had certain intended results not get those results is sad. Treasury says that the reason why they could not be here is because they only had 8 days' notice. And I really would like to have heard from them. But one thing needs to go forth from this hearing is that we can do better, and that's what you're saying.
Yes.
Sometimes I think, Ms. Romero, we get caught up, and I've seen this in government in various ways, in a culture of mediocrity. And certain agencies get to a point where they could do better, but for some reason they don't. And so I guess, when you have the, and this is what I want your answer on this. So you think the law, the way it was drawn up, the law itself, could have been clearer, or you just think that it was clear enough and there was just some disregard, or both, disregard of doing what was necessary to get the full intended results? Are you following my question?
Yes, absolutely. Look, Congress's intent is clear in this statute.
So it's not the statute.
I think this is the point I was trying to make. There's a lending plan that's a safeguard. But you've got to take responsibility when you're Treasury or the banking regulators who are looking at that lending plan to make sure that Congress's intent is met. And I think what the Chairman was saying was if they can't take accountability to do that, then maybe Congress has to lay it out more clearly. But they shouldn't have to. Congress shouldn't have to. I mean, Treasury and the regulators have got to take accountability. And when we look at our work, I know some people think that an IG's job is criticized. That's not what we do. We're trying to make these programs better. We're trying to get help to people who need help from TARP, small businesses that needed help from these programs. And we're trying to say if you took a bank out of TARP that would pay less in dividends to taxpayers, that trade-off is fine and good if there's a meaningful impact on small businesses and they get the benefit of that. And so all we're trying to do is say, how do we get there? Because let's remove the obstacles that didn't allow us to get there in the first place, and let's move forward. And when Treasury takes a defensive posture and just defends what they did and doesn't talk about what they should have done or still can do, it's not really an effective response to an Inspector General's report, and unfortunately, that is typically what has been happening with our reports, whereas we're trying to work together with them to make sure that the intent of Congress is met. We're not trying to criticize for criticism's sake. We're trying to make this better, and that's what's frustrating.
I got to tell you, since I've been in Congress over 16 years, that's one of the best statements I've ever heard, what you just said. And I really mean that, because you're right. That's what it's all about. How do you make sure that things are done in an effective and efficient manner? I mean, it's simple. I tell folks all the time, it is so important to me that government functions properly. It's so, my constituents need government to function like government is supposed to function. And the statement you just made about the role of the IG, I totally agree with you. And hopefully, Treasury is listening to this, and for future times, maybe we'll have a better situation. But thank you very much, and we thank your entire staff.
Thank you so much.
I want to thank, again, all of you for your service and for being witnesses here today. We stand adjourned.
Thank you.